You think you own your money. You earned it, you worked for it, it sits in your account with your name on it. But what if none of that is actually true? What if the money in your account is quietly losing value while you sleep, being taxed before you even see it, and nudged out of your hands by systems built specifically to take it? That's not a conspiracy. That's just how the machine works. Let's start with the simplest lie you've been told. $1 today is $1 tomorrow. It isn't. Every year, prices creep upward. This is called inflation, and it simply means the same amount of money buys less over time. A candy bar that cost a few cents decades ago now costs over $1. Your grandparents' savings account, the one that felt like a fortune in their time, would barely cover groceries today. The number in your account might stay the same, but the value behind that number is shrinking constantly, silently, without asking your permission.
Why does this happen? Central banks target a small amount of inflation on purpose. A little bit of inflation encourages spending and borrowing, which keeps the economy moving. But here's the part nobody explains clearly. Inflation acts like an invisible tax. It doesn't show up on a receipt. It doesn't require a vote. It simply erodes the purchasing power of every dollar you hold, especially the dollars sitting still in a low-interest savings account. If your money isn't growing faster than inflation, you're not saving. You're losing, slowly, every single day. Picture two people. One keeps every dollar under a mattress. The other puts that same money into something that grows over time. 10 years later, the first person still has the same number of dollars, but those dollars buy noticeably less than they used to. The second person, even with modest growth, has kept pace with rising prices, or beaten them entirely. Neither person did anything dramatic. One simply let a silent force work against them, and the other didn't. This is why financial advisors constantly repeat one phrase: make your money work for you. It sounds like a cliche, almost too simple to matter, but it's describing something very real. Cash that sits idle is a melting ice cube. It looks the same on the surface, and it feels safe, but the shrinking is happening whether you notice it or not. Now let's talk about the second system working against you: debt. Debt is presented to you as a tool. A mortgage lets you own a home. A car loan lets you drive to work. A credit card lets you buy what you need before payday arrives. All of that sounds reasonable. But debt was never designed purely to help you. It was designed to be profitable for the lender first and useful for you second. Every loan you take carries interest. That interest is the price you pay for using someone else's money today instead of your own money later. On the surface, that seems fair. But compound interest, when it works against you instead of for you, can trap people for years. A credit card balance that feels small can double, then triple, simply by making minimum payments. The bank isn't hoping you pay it off quickly. The bank profits most when you take the longest possible path to freedom. Have you ever noticed how easy it is to get approved for debt, but how hard it is to get advice on getting out of it? That's not an accident. The system profits from your debt existing. It doesn't profit nearly as much from your debt disappearing.
Think about how debt is marketed to you. Approval takes seconds. The application feels effortless. Rewards points and cashback offers make the decision feel like a win before you've spent a single dollar. But the fine print, the part explaining exactly how interest compounds if you carry a balance, is rarely highlighted with the same enthusiasm. Nobody sends you a celebratory notification for paying off a loan early, but plenty of companies send reminders, discounts, and limited-time offers designed to keep you spending, and by extension, keep you borrowing. Not all debt is bad. A mortgage on a home that appreciates in value, or a loan that helps you earn more than it costs, can genuinely build your future. The problem isn't debt itself. The problem is debt taken without understanding its true cost, debt used to fund things that lose value the moment you buy them, and debt that quietly grows because minimum payments feel manageable in the moment. Then there's taxes, the third quiet hand in your pocket. Taxes fund roads, schools, hospitals, and services people genuinely rely on. That part is real, and taxes themselves aren't some evil trick. But most people never see the full picture of how much they actually pay. Income tax is taken before your paycheck even reaches you. Sales tax is added at checkout. Property tax arrives every year if you own a home. Fuel tax is baked into the price at the pump. By the time you add it all together, a huge portion of your income disappears into places you never consciously chose to send it.
Here's the uncomfortable question. If you had to write a check for every tax you pay, all at once a year, would you feel differently about your financial life? Most people would, but taxes are designed to be invisible, deducted automatically, spread out, disguised inside prices. When something is invisible, it's easy to underestimate. And when you underestimate how much is leaving your hands, you overestimate how much control you actually have. Some economists call this fiscal illusion. It's the idea that spreading a cost across many small, painless deductions makes the total feel far smaller than it actually is. Paying a large lump sum once a year would provoke outrage. Paying a small amount, constantly, quietly, barely registers at all. This isn't a flaw in the system. It's a feature of how the system was built, and it works exactly as intended. Now, here's where it gets even more interesting. Even if you understood inflation perfectly, even if you avoided debt entirely, even if you tracked every tax to the penny, there's a fourth system working against you that has nothing to do with policy. It's psychology. Modern spending isn't accidental, it's engineered. Stores are designed with specific layouts to maximize how long you stay and how much you notice. Bright checkout displays exist because impulse decisions happen fastest in the final seconds before a purchase. Subscription services default to auto-renewal because forgetting to cancel is more profitable than remembering to. Even the phone in your pocket is built with notifications, discounts, and countdown timers designed to trigger urgency, because urgency bypasses careful thinking. Have you ever bought something impulsively, then wondered 10 minutes later why you actually needed it? That feeling isn't a personal failure. It's a signal that the system worked exactly as intended. Marketing isn't about informing you. It's about creating a feeling strong enough to override your logic for just long enough to complete a transaction. Credit card companies understand this better than almost anyone. Paying with plastic feels less real than paying with cash. Studies on spending behavior consistently show people spend more when the pain of paying is delayed and disconnected from the physical act of handing over money. That disconnect isn't a side effect, it's the entire design.
Consider how many decisions you make in a single day without ever consciously deciding anything at all. The default option on a subscription renewal, the suggested tip amount already selected for you at checkout, the buy now, pay later button placed conveniently beside the price, making a purchase feel smaller and more manageable than it truly is. Every one of these details was tested, refined, and placed exactly where it is because it changes behavior in a measurable, predictable way. You're not imagining it. You are quite literally standing inside a machine built to shape your choices. So let's put these four systems together. Inflation quietly shrinks the value of your money. Debt profits from keeping you attached to it longer. Taxes remove portions of your income before you can meaningfully react, and consumer psychology nudges your daily decisions in directions that benefit companies more than they benefit you. None of these forces require a hidden committee planning against you personally. That's what makes this so much harder to see. It's not a conspiracy of individuals. It's an ecosystem of incentives, each one operating independently, all of them pointing the same direction, away from your control.
But here's the reframe. Understanding a system is the first step to working with it instead of against it. Inflation punishes cash that sits still. So money that isn't actively working for you, growing through investments or appreciating assets, is money losing a slow, invisible war. Debt punishes people who don't understand the terms they agreed to. So the antidote isn't avoiding debt entirely. It's understanding exactly how interest compounds and using debt only when the math genuinely benefits you. Taxes punish people who never plan. So the more visibility you build around what you actually pay, the more informed decisions you can make around retirement accounts, deductions, and long-term planning. And consumer psychology punishes impulse. So the single most powerful habit you can build isn't complicated budgeting spreadsheets. It's simply creating distance between the urge to buy and the moment of purchase. Even a short pause, even just asking yourself one honest question before spending, can interrupt a system built entirely around speed and urgency.
Here's something most people never consider. The people who build these systems aren't villains twirling mustaches in a back room. They're responding to incentives, just like you are. Businesses exist to maximize profit. Lenders exist to profit from interest. Governments exist to fund themselves through taxation. None of that is secret. It's simply rarely explained clearly, and rarely taught in a way that connects the dots for the average person trying to build a stable life. So, where does that leave you? Not powerless, just informed differently than before. You cannot personally stop inflation. You cannot rewrite tax law. You cannot dismantle the marketing machine built by trillion-dollar industries. But you can choose where your money sits. You can choose to understand the terms of any debt before signing it. You can choose to look closely at where your income actually goes, instead of assuming it simply vanishes. And you can choose to build a small gap between temptation and action, a gap just wide enough for a clearer decision to slip through. That gap is where control quietly returns to you.
Think about the version of you from 10 years ago. Would that version recognize how differently you see money right now? Would they be surprised that the problem was never a lack of intelligence or effort, but a lack of visibility into systems designed to stay just out of sight? Awareness doesn't erase these systems. It never will. But awareness changes your relationship with them. Instead of reacting blindly to inflation, debt triggers, invisible taxes, and manufactured urges, you start recognizing the pattern the moment it appears. And recognizing a pattern is the first step toward not being controlled by it. So the next time your paycheck lands and taxes have already been quietly deducted, the next time inflation makes something cost a little more than it used to, the next time a screen flashes a countdown timer urging you to buy right now, pause, just for a moment. Ask yourself who benefits most from this decision happening quickly. Because the truth isn't that money is inherently confusing or that you're somehow bad with it. The truth is that an entire ecosystem profits from you never slowing down enough to ask the question. You don't own your money. Not entirely. Not yet. But you can own the decisions you make about it, one deliberate pause at a time.